Hey everyone, this is the Bittan Brief. I'm your host, Alexander Bittan, and in this video we're going to be going over Nike stock. It is trading at a 52-week low today on the tariff crash we had in the market today. So let's get into this stock. But before we do, make sure to put a thumbs up on this video. It really helps the YouTube algorithm. This is a new channel, and if you're not subscribed to the channel and you do like stock videos, stock analysis, please subscribe. Now let's get into the stock. Right now, the stock is trading at $56.93. It's down 12.36% at the time of this recording. We are midday, so the stock will continue to change by end of day. We'll see where it ends up. It is April 3rd, 2025. This is what I consider the tariff crash day. Now, whether you are a supporter of the tariffs or not is besides the point. The market has crashed on Trump's tariffs that he put out yesterday. This stock's 52-week high was $98, and if we go all the way back to around the end of 2021, we're talking about a $180 stock, somewhere around there. So from that price, we're down almost 70%, 68% from November 5th, 2021, when it was about $177 a share. So I think to start off, let's just talk a little bit about one of the bigger supporters for Nike, which is Bill Ackman. We knew he boosted his stake in Nike for Q4 of 2024. We saw that he basically added about 15% to his stake then. Looking up, this may or may not be accurate, but online I found that he's holding about 11.2% of his portfolio in Nike right now, which is currently sitting with an average price that he's paid for of about $75.24. That's what it's reported online here at. So Ackman is a supporter and fan of this company. Now, when I look into their revenues, it's clear this was a growing company for a long time. If we go back to 2015, about a 10-year chart, we could see that their revenue was steadily growing from 30 billion, 32, 34, 36, 39, dropped down to 37 billion in 2020. Obviously a little, crash there, but then 44 billion, 46 billion, 51 billion. After that, people started wearing more relaxing type of attire and whatnot, more work from home, things like that. So this business was a growing business. When it comes to net income in that time frame, it also went from $3.2 billion, and then it peaked around $6 billion in 2022, kind of stayed a little steady there, 5 billion, 5.7 billion in 2024. So looking at that on its own, everything would seem fine. But then when you start to look at estimates and the most recent quarterly report, you start to realize there's a little bit of trouble. They've had some trouble with inventories. We have analysts expecting income to drop down from 5.7 billion to 3.1 billion in 2025. We're expecting 2.9 billion as the estimate in 2026. So we just have this income dropping pretty significantly, and revenue as well coming down to about 45 billion. So that is a worry. You pair on the tariffs they could be expecting to have to pay, and you kind of have this stock that's basically just been heading downward. So you look at the multiple, the PE, and it's sitting now at 18.8. This is the lowest I've seen it. I mean, this is a pretty big brand, Nike, that's always commanded a decently high PE. It's one of the reasons I never own the stock, is simply because I don't like paying too high of a PE, especially it's, some might say they're a tech company in some ways or form, but really, it's an apparel company. They make sneakers, they make clothing, sports apparel, and the apparel business usually trades at a pretty low PE. Now, they have a powerful brand, so they do justify a higher PE than just any other apparel brand, but how high is the question? I've never liked to pay 25, 27, 28 times earnings for the stock, but that is historically where they traded. Now you can see in that 2021 timeframe when the stock really was like peaking, their PE really just went a little bit out of hand. It even skyrocketed above 80 at one point there. So obviously really overpriced at that price point, but now we're, in the 18 times, and we're going to go over if that's justifiable or if it should be trading higher. Now, with the future of the stock, expecting a decline beyond that, who knows, if it's going to continue to grow. We'll see what management does. We have to decide what multiple you should pay for this company. Well, on a price to sales ratio, they're also at a bottom of just 2 times sales. Now, this company has historically traded maybe at 3 to 4 times sales. It had peaked at 6 times sales, but 3, I'd say, times sales is probably the fair price for this company, maybe 3.5. Right now we're at 2 times sales. So definitely it is trading lower if you're looking at it at a price to sales ratio, just to get an idea of where it was historically. So let's pull up their most recent quarterly report. So it's their third quarter report, which basically had shown that their revenue of $11.3 billion was down 9% compared to the year prior. And their direct revenue, because they made a big push to selling online direct rather than wholesales, direct revenue was $4.7 billion, down 12%. And wholesale revenue of $6.2 billion was down 7%. Gross margins decreased 330 basis points to 41.5%, and diluted EPS was 54 cents. So when you look at the revenue being down 9%, it's not that bad, but what it really did, because of the margins and whatnot and some of the expenses and things that were going on at this company, what happened to the net income on a 9% revenue drop was it basically going down 30%. We see that diluted earnings per share of 54 cents was a decrease of 30%. That's a huge decrease in EPS. And that is the worry. If things get worse, how much more does EPS come down? Now, when it comes to shareholder returns, so buying back stock, dividends, things like that, they continue to have a strong track record. They've consistently increased returns to shareholders, including 23 consecutive years of increasing their dividend. In the third quarter, the company returned approximately $1.1 billion to shareholders, including dividends of $594 million, which is 6% up from the year before, share repurchases of $499 million, so $500 million in buying back stock, reflecting 6.5 million shares retired as part of the company's 4-year, $18 billion program, which was approved in June 2022. Now, it is important to note, in this quarter, there was net income of $800 million, and the company returned $1.1 billion to shareholders, which means that between their share repurchases and their dividends, they spent more on shareholder return than they even made. That is something to keep in mind, because that's not something you can consistently do. It's, they could keep paying their dividend. Obviously, $594 million so far. They made $800 million. So they still, it's most of their income. They have $200 million left, but they wouldn't be able to buy back shares the way they're buying them back and give this dividend indefinitely unless the business improved. Now, let's figure out what they paid per share, because they've spent, they say, $11.8 billion to acquire 119.3 million shares since the start of this program to buy back shares. Well, if you do the math, that comes out to $98.91 a share. That's the average price they've paid to buy back shares in this time frame. Well, today, with the recent drop, the stock is trading around $56 a share. So this has not been well spent money, unfortunately. And I'm sure the company would not like to see their share price at where it is. But clearly, if you're buying the stock now and you haven't had a position, well, you're buying it cheaper than they've been paying for it. But if you've owned the stock and they've been using their cash to buy it at double the price it is, it's clearly, it worked out to go against them, these buybacks, to be honest. So let's look at a positive note for the future of the company, something that I saw come out not too long ago that I thought was really interesting, and that is Nike Skims. Nike teamed up with Kim Kardashian, the shapewear brand Skims she owns, and they're trying to reach more women in this new brand that is going to be a collab between Skims and Nike. It's going to be a collection of apparel, footwear, accessories, and it's going to debut this spring with a global rollout planned for 2026. Personally, I think this is going to be a great collaboration. It's good for both Nike and for Kim Kardashian's brand, clearly. So I think this is the type of things that Nike needs to be doing. I think at the end of the day, regardless how big of a brand Nike is, in the fashion world, it's always, what do you have next? What's the hot thing? What do people want? Any newcomer can come in and make a cool brand and have cool collaborations and take that business away from you. So you have to be on top of things. You have to work with what's hot. You have to build continuously. And ultimately, I think this is a net positive, this relationship that they're going to have with Skims. Just like their relationship with Jordan has been extremely successful for Nike, and it has made a fortune for Michael Jordan, I think this partnership, not going to be nearly as big as the Jordan partnership, but it is going to be another business line of what I consider to be accretive income for them that they wouldn't have without this partnership. So the bottom line, is the stock worth owning? Now, to answer that, you got to first answer, do you believe the company is going to find growth again in the future? You also have to answer, do you believe management can turn this ship around? So those are the two questions you really need to believe. And, some will say yes and some will say no. And that is going to determine where this stock goes. If they find growth again, then the brand could push to a 25 to 30 times multiple. It's been there plenty of times in that range before. But if they flatline on growth and margins, then 15 to 20 times could be justified. And, for the brand they have, or it could be even lower. Now, if margins continue to compress and if revenue continues to drop, then the pain could be really far from over. A lot of other apparel and shoe brands trade from 8 to 12 times earnings. Gap would be an example which trades around 8 times earnings on its recent drop in its stock. You also have companies like Crocs, which trade around 10 times earnings or so. So to think that this company will always trade at 20, 24, 25 times earnings, it's not accurate. It all depends on the business. They were a growing business with growing revenue, so they were able to justify a higher multiple, especially with the brand power they had. So what is fair value? Well, their EPS in 2024 was around $3.95. Analysts expect their EPS in 2026 to be anywhere between $1.64 to $3.19. We're talking 2 years out and having basically a lower EPS. That's not great. But let's give them the benefit of the doubt, and let's go to that top of the range of analysts of $3.19. If you put a 20 PE on the $3.19, which I think is fair seeing as it is a lower EPS, so that you have to take into account, but you also have to take into account the brand power they have, and that they may continue to grow that EPS in the future. So if you put a 20 PE at $3.19 of earnings, you get a $63.80 share price. But if you give the stock a 25 times multiple, it'd be an $80 share price. And this is 2026. Now, of course, EPS can be revised higher if the management makes positive changes and analysts re-rate the stock. But the risk is it could also be revised lower. So what's the downside? Well, the downside is, imagine they're at the bottom of the range of $1.64 of EPS in 2026. If you gave a 20 times multiple on that $1.64, you'd have a $32.80 share price. But the thing is, if they were doing that bad, then I don't know if people would give the 20 times multiple. Maybe the multiple drops down to 14 times. Then you could see how that stock goes to $23 a share, which would be 50% below today's price. So giving a price target on a stock that's been having trouble when analyst EPS targets are spreading into this wide range is extremely difficult to predict accurately. So for this reason, I couldn't make a stock like this a large position in my portfolio. It just could go either way. But what I can do is nibble, start a small position, wait and see how management executes before deciding where I think the numbers are going to end up going. And that's what I did today. Today, at today's share price of around $56 a share, I bought a very small position. Are you buying Nike stock? Do you own the company already? What's your opinion on management? What's your opinion on their future? Let me know down in the comments. And if you enjoyed this video, make sure to give it a thumbs up and subscribe to the channel for more videos like this. Let me know which stock you want me to look into next. Write it down in the comments. And that's all, everybody. This is the Bittan Brief. I'm your host, Alexander Bittan. Until next time.